Hello and welcome. You're watching Business Today Television. I'm Sakshi Patra and this is our special edition on Market Masters. You all know this is a show where we get the topmost voices of stock markets to really help you understand what are the strategies which are at play, how should you be really understanding the micros and macros at this point in time, and what is it that the top market investors are doing at this stage so that you can take some inspiration as well. Our guest today needs no introduction in the world of markets and finance. He's a seasoned voice with a sharp insight on the markets and the economy at large as well. Let's welcome Mr. Ajay Srivastava. He's the CEO of Dimensions Consulting, and we welcome you, sir, on our program today. There's so much happening on the D Street and so much to really understand from you, who's been looking at the markets for decades now and has been seeing how things have shaped the market's tenor and texture at large. Let's start off with the global impact on the markets right now. That's the theme that has been running for the last quarter now. From April onwards, we've been talking about the tariff war that started off with Donald Trump announcing massive tariffs across the world. Calmed down a little bit. There was a taco trade at play. People talked about how Trump always chickens out. But again, we do not have a deal yet. Something that was, seemingly very, very possible for us when the deal announcement started to happen, when US said that, yes, we are going to be signing some deals with our, best well-wishers and with the countries who we have the best of, relationships with. India seemingly was seen to be one of the first countries that could probably strike a deal. But it's July 9. We are sitting on this deadline, which had to be the original deadline for all the reciprocal tariffs to come into play. And now we have 14 countries which have gone back to almost the similar tariff announcements that were made in April. We are not featured in that list, and yet we are just hoping that some or the other deal will come our way. How are you looking at this scenario, sir?
Actually, first thing is that, if you look at the equity markets, that's worked very differently. After the first problem which we encountered when we announced this Independence Day stuff and so on, today the stock market of US, Europe are all at the historical highs.
Yes.
So as far as the equity market is concerned, it has ridden through the storm called this one, and therefore there is a lot of dichotomy between a liberal quote unquote press which is telling you that heavens are going to fall apart with the tariff problem in America, and the real money which has got invested, NASDAQ, S&P, Europe has done a remarkable job in coming back in the market. So therefore, don't believe all what the press says at this point of time. The real world is voting and saying people still need to eat food. People are doing trade. These tariff barriers are going to be, at the end of the day, benefit the world. If India has to drop tariff barriers, let's just take an example. We got to start producing at a cheaper cost. We got to start competing with other markets without protection. That makes us more efficient, doesn't make us inefficient. There can be pain, but the beauty of tariffs, the whole thing is that every country starts to get more efficient in what it does. And equity markets have understood the game, and therefore all markets are at historical high. India has lagged behind a little bit, but let's not worry about that too much. We will talk about it. But the fact is, global market at an historic high. Europe, which was absolutely dead as a continent, those markets have recovered and been historic high. So look at the reality of money moving stock market and ignore the press and the yagger that world is falling apart because of tariffs.
Absolutely. But still on the tariff front, how do you think India is positioned compared to the other Asian peers when it comes to tariff levy? Even with the current scenario, we're a tad bit better than, say, a Bangladesh or a Vietnam on the textile space. Some of those stocks were moving up. We are yet to see what comes in our way. But how do you think our competitiveness lies in this new world order?
No, I think we are good. I think we are broadly very good in autos, ancillaries, engineering. We are very good in pharmaceuticals. So I think we are good in cotton and textiles and garments and everything put together. I think there are certain hiccups we will encounter as we go forward in the agriculture sector because that's heavily protected, which is all over the world. The same problem comes that a consumer will gain when you get more soya beans, when you get more oil in this country and with those duty. But broadly speaking, I think Indian export sector is pretty vibrant. We are pretty competitive. There will be pockets of pain, always will be pockets of pain, but there are also pockets of joy because reciprocally access to the US market is what we always wanted and have got it. Our whole services paradigm is built on the US industry. Our whole pharmaceutical is primarily came out from the US. So let's not, look at only the pain point. There's 70% people are going to gain. Indian
Yeah.
consumer will gain. Yes, 20-30% of people in the farming trade may lose. But life has never been always win-win. You win some, you lose some.
Absolutely. What would you say on the 200% tariff announcement on pharma space? Yet we have been given a 1.5 year for the world at large to really get their act together, Donald Trump says.
You know, it's interesting, very interesting. I work a lot with pharma space. Supply chains can't be developed overnight. The fact remains. Therefore, yeah, he's already provided 1 year because he knows it can't change in 1 year. 1 year is a long time in this world, in this one. So I think there's a lot of stuff will happen down the line, 1 year down the line. And as far as India is concerned, our generic API companies are not going to lose very much because you can't build capacities overnight plants. Yes, the end product, which is the medicine that you see in the end product, that part of it can move to the US, and it has done that. But and that's already giving him the benefit in the US. Sakshi must know this. A lot of production is actually moved back to the US. US has got a lot of capacities lying idle. So therefore, a lot of capacity moving in. And if you remember, one Indian company, Zydus, just invested in a biologics facility in the US to produce there. So we'll also become smarter. Indian companies will start to produce locally to offset these issues on which may come around for the complex medicine, etc., biologics particularly. But API, I don't think so will ever get affected because that's a cheap end of the cycle, which America does not want to compete, will not compete. It's going to be China and us in that. And I don't think that's going to be affected. Yes, headlines make a difference, but practically on the line, I doubt very much will change, except that a lot of Indian companies will start to invest in America to produce things locally.
Okay. You began by talking about how global markets, US markets are at record high levels. When we compare with India, and even when we compare within Asia as well, we have just gained about 7, 8, 9 odd percent vis-a-vis some of the other countries within Asia Pacific as well that have rallied 20-25%. What do you think is keeping India to scale back to record high levels and climb further? And do you think the valuation picture still remains sticky even when comparatively we have grown lesser in terms of the stock prices when we compare with the developed or the developing world?
See, actually, if you look at it, actually, we are much better off today than we should have been. If you look at the advanced tax numbers, 4% growth rate. If you look at the GST, that's been one of the lowest numbers. If you look at corporate results, lower number. Actually, we are holding up quite nicely and firm. The parent problem is that we peaked too early in September. And from September peak till now, still 75% of the stocks have not recovered their value, including some large caps. You saw what happened to Trent as a retail company. It's not recovered. It was 8,300 peak.
Sure.
It's at 5,500 today. So our problem is that Indian investors are sitting with lots and lots of losses because they've seen from September till now, 75% of stocks have not recovered their value. And if advanced tax is 4%, you can't expect a great thing to happen to the economy. Our economy is slowing down. Our P multiples are very high at this point of time. Gives you less incentive to buy. It's a very simple model. If you want to buy today, how do you generate a 20% return 1 year down the line? And if you can't, then you don't buy. So I don't think India is a market where people are selling off. I think there's a great hesitation to buy into a market at this valuation, given that our advanced tax growth is only 4.5%, which gives you a trajectory to the corporate earnings and growth. So I think it's going to be wait and watch. We'll see what June results sound like. And then maybe we'll go back to see how does the festive season perform. Select stories will do, but broadly market is overpriced compared to fundamental. And that's why buying interest is minimal.
On the earnings front, like you pointed out, we will see starting tomorrow TCS come out and the rest of the sectors then will follow. How would you expect, this earnings to pan out vis-a-vis the last quarter, vis-a-vis the last year? What is your broad expectation? Are there also any sectors of preference in terms of outperformance that you expect in underperformance where you need to caution the investors?
See, the beauty of IT is that there is no expectation. People are saying nothing more can happen from this. So IT sector can only surprise you on the upside.
Okay.
Okay, you can't get more downside to this at the end of the day. So all downsides are factored in. You're pessimist, no contract, no growth rate, common common currency growth will be about 1.5-2%. So everything negative is built into the psyche of an investor at this point of time. Now, the only thing they can do is IT companies can announce a few contracts and surprises on the upside. I don't think there is tremendous downside, but it's an upside which they can surprise you with. Now, whether it is limited, temporary, or long term, I do not know the answer, but I know the answer. Fundamentally, when all investors are pessimists, the market surprises you on the other side. In other sectors of the economy, I think you will see very clearly retail has shown us a clear degrowth coming through in the system. And when I say degrowth, means degrowth in terms of rates of growth, in terms of same sector sales. Consumer is still going to be anemic compared to the valuation these companies perform at that. I think that's going to be. I think good part would be auto ancillary should be decent numbers. At least
Okay.
select companies will have very decent numbers. And you will see hotels, the regular stuff, hotels, airlines, all will do well. Some of the new companies which have come up in the industry, the e-com, the fintechs, I think they will do fine at this point of time. Banks, mediocre performance because they're not growing their loans. So it's not going to be easy for them to perform. Capital market stocks have been on fire. You've seen it at the end of the day. They do correct, but they come back. So I think it's a broad mixed bag which is going to come out. It gives you enough time to position your portfolios, no hurry to invest. This is such a perfect time that there's no pressure on investor to invest.
Okay. Okay. So, when it comes to specific sectors that you would want investors to stay clear from, are there any sectors that you are absolutely not looking?
I think retail is very clearly, large cap retail is very clearly, we are not looking at all. In fact, in some of the cases, we are short positions we are running at this point
Okay.
of time. So
Okay.
retail is definitely, mass retail is definitely off the agenda at this point of time. Chemicals, we are still zero at this point of time. By and large, they have, it's an industry which is cyclical. It takes time to kind of get returns to us. The global prices are what they are. So I think chemicals, agrochemicals, whatever they are today, I'm just, let's say, contextualized from today's purposes. I think it's a no-go territory for some time until you see clear recovery coming through. Uh, as I said, I don't know how to say this, but the fact remains that no matter which pocket you look at, if you compare the growth rate to the valuation of the stocks, it gives you a picture to say, yeah, am I going to buy this at a P of 40 or 50 with a growth rate at 7%? And I think that's bothers across all sectors. Leave aside hotels and airlines and so on and so forth. Some are very steady, which are going to gain, like, say, telecom, because the interest cost has gone down. So companies like telecom companies, the biggest borrowers today, they will gain at this point of time. You may find a little bit of gain in capital goods stocks because they have seen some traction coming back. So I think telecom, capital goods, select auto companies, engineering companies are going to be fine. But rest, I think take a pause. What's a hurry to invest?
So, if I have to ask you, what are the triggers that you believe can actually steer the markets higher from here on? Will it be the earnings and the sustainability in the growth on profitability and revenue front that we see? Will it be a settled global order that we are looking at? Will it be the policy rate cuts that are happening across the world when they synchronize themselves clearly with the vision? What is it that will really drive things higher into a clear uptrend sans the volatility?
Single GST. GST change, rationalization, whatever you want to call it, has been pending
Yeah.
for a long time. And I think that's where the needles are, is that whether they're going to come up and bite the bullet and say, okay, we got very high tariff rates in terms of automobiles, the two-wheelers, very high tariff rates, consumer products have high tariff rates. Can we rationalize them to a lower cycle so we kickstart the consumption cycle of this economy? I think that's where the whole bottom line lies. You got to kickstart the consumption cycle. Number two, you mentioned tariff. If tariffs go down and you open up the economy, then you can't expect that Indian companies will compete. If they pay 28% GST and they want to compete with a guy from the US who pays only 8%, then you can't compete. So part of the tariff paradigm will be that government of India will be forced to redo the map of and the math of GST. And that's what I say, that if the tariff thing gets really bad, then India has to looking at GST reduction, which can kickstart the economy, kickstart consumption, kickstart the whole engines going. Today, all of us put together, honestly, are paying just too much money to the government through various taxes. If you look at an individual, between the toll tax, income tax, GST, put together, a substantial income is going to the government. I think that needs to be pared down or stopped, and some reverse has to happen for this one. And interest costs, interest rate reduction. Now, all the saving community who are going to invest now are going to have less money to spend because interest costs have gone down. So, on one side, all these savers are going to have a problem. Other side, we pay higher GST, we pay toll taxes, we pay income taxes, we pay securities tax, we pay capital gains. Put together everything, I don't know how much is left with most individuals to spend. And increase a little bit. My request to government would be increase a little bit. People will spend, companies will invest.
Fantastic. So GST and a rate rationalization is something that could definitely drive the sentiments much higher. That's the need of the hour to kickstart consumption. Is there any risk also that you are watchful of at this point in time? I mean, in the first half of the calendar year, probably everything that could go wrong has gone wrong. And the markets somehow have managed to just pull themselves up despite climbing all walls of worry. But is there still any risk lurking that one should be keeping one eye out on?
Oh my God. Are you saying it's going to be sleepless night? Answer is you should have sleepless night if you got money invested in any market for that matter. And I think one of the key issues in the risk that we see today is that, you see geopolitical, how fast the movements happen and how fast things change today. And the risk comes from something which you don't anticipate. So unfortunately, I has to be Nostradamus to say where the risk is going to come from. But every time the risk comes from a different side, which you don't anticipate. Nobody saw India, Pakistan. Nobody saw a bombing of Iran. Nobody saw tariff barriers coming in. So, it's hard to predict what the next thing going to upset the market is going to be. It could be just anything out of the market. But the key issue is, and I think that's the important point is, how much money do you have in the bank to buy when the market volatility starts and you get real good deals in the market?
Yeah.
90% of investors remain fully invested and watch the cycle go through. Key is keep some money with you because corrections will happen. And when they happen, that's the day to walk in with courage and say, it's a big red tick day. I want to make a green, buy. If you can do that, I think you'll do well. And as I said, 75% of stocks still haven't made it to the September high. So you can imagine what happens to the portfolios. If you had invested in September, your returns would have been very different than if you just rode through the whole market. So trick in the game is don't worry too much, but keep money on the side, 10 to 15% minimum of your portfolio size to exploit these opportunities.
Absolutely. What do you make of the recent IPOs and the IPO pipeline that stares at us? And for the retail investors, who may be keeping that stash for the IPOs that are coming in. We've seen HDB, large IPOs probably sucking some liquidity out from the secondary markets right now.
Well, when I look at the valuation of IPOs, I have to be mad in my head. You can shoot me in the head. How the issues are coming out and getting placed in the market. It's just incredible. Now they are getting placed. People are buying, so I can't argue with the market. But none of them can justify the kind of valuations coming out. 40p, 50p, 60p, name it. Company is degrowing. The example that you said, company degrew, but had a great this thing. So yes, IPO is very good. Our depth of a market is going up. A lot of companies are accessing capital, which is a great thing to happen. But I'm not sure that these valuations, and you've already seen that in the last 6 months, the kind of IPOs have come, most of them have not given a positive return, or some have given with very minimal return. So I think now greed is overcoming everybody, all the bankers at the end of the day. Push the index higher, push it higher, push it higher. So for investor to make money, very difficult. And what do I say at the end of the day? Market gives you some returns, but at these valuations, you want to buy IPOs. I do not know what sense it makes, but they're able to place it. So let's be honest, our mutual funds are buying it in India. No, please understand, everybody else is selling. The PE funds are selling, the overseas guys are selling. Our mutual fund who are sitting with retail money are the biggest buyers of IPOs today at these valuations. Good luck, my friend, for these valuations to make a return for the investors.
And SIP flows that continue at record levels. Even today, we've seen over 27,000 odd crore rupees of money poured in into the equity mutual funds at this point in time. What would you then say to this entire space that goes big on SIPs?
It's counterintuitive. The fact that the retail investor doesn't look at two things which a professional investor does. He doesn't index himself to a return to alternate assets. So when we look at equity, we look at the minimum 20% threshold, or a P looks at 25% threshold. We look at end of the year performance. Retail guy is saying, okay, I'm putting the money a little bit. I do not have to invest it. I will see at the end of the 5 year, 7 year cycle where my money is. So, it's a very different paradigm in his thinking. He doesn't look at market going falling up, down. He's looking at accumulating. And I think a very good thing he's doing, because you certainly are not doing what you should not be doing is go play in the futures market. And you saw what happened in the futures market. So to them, I would say certainly, it's the best form, safest form to invest. They cannot time the market. They don't have space or time to analyze the market. For them to invest in SIPs, perhaps is the best thing they can do for themselves. The
Yeah.
only thing is they've learned a lesson now is put some money for metals, also precious metals, which
Yeah.
their grandmother used to tell them. They never used to listen. But now everybody feels grandmother was the best investor.
Absolutely, absolutely, and we have seen how the Indian housewives have beaten the topmost fund managers there with their large investments in gold and silver over the last many years with the substantial rally that has come in. One other key concern that emerged last week was SEBI's action on Jane Street, and that's something that's very, very important for us to understand with your insights that you have to share with our viewers. Now, on the one hand, there are questions about whether what Jane Street did is legal, illegal, did they manipulate the markets? Will SEBI be able to prove that? Will the final order be able to clarify as to how, the intentions were malified? On the other hand, there is this retail investor who's questioning that whether any kind of strategies or top-notch, strategies that they can adopt will ever be able to stand against such large machines, quant strategies or algo trades that happen. And thirdly, for us to really think at the large, scale as to whether we are a mature market enough to have F&O exposed to the small retail investors at large, or do we need better systems to be able to protect them? How have you looked at all these scenarios that have emerged out of Jane Street, and what's your learning there, sir?
I think three things are important. One is we need a great F&O market. There's no doubt. That gives depth to any market. That gives you risk and return metrics. So you need the F&O market to be a proper stock market, and you can't live without it. So we need that market. So let's be honest about it. Nothing wrong in that market. Number two is in any market, even the US, people will come and do wrongs. Okay, it's every market. There's a milk in long bag. Everybody's done wrong in the market, and ultimately the trick is who gets caught and how fast do the government respond, regulatory agencies, to close that loop. The third aspect is in the days of algo, the retail investor has no chance against an algo. That machine calculates faster, analyzes faster, and orders faster, sells faster, buys faster. You cannot match those machines at this point of time. So retail investor is at a disadvantage, definitely disadvantage with those machines. The question which only comes up in all this is that when it was first discovered that this was a quote unquote manipulation, I will come back to manipulation. Why was the action not taken that time? Why it has taken 2.5 years for 36,000 crores of profits to be made? It could have been stopped long back. There's nothing to stop. That's the only question to me is there been a delay at some end which this could have been stopped, and some of the stuff that happened after the last 2 years could have been not happened. But fact remains that the very thin line between a strategy and manipulation. All right. It's a very thin line because no one player is dominant in the market. You can't say that Jane Street is dominant, right? So therefore, I think the only thing here is that if action was taken and immediately when the first problem was highlighted, I think a lot of this debate would have ended that time. Now we're looking at 3 years of trading and saying, and Sakshi, let me tell you, in worldwide, no case goes to the court. Every single securities case is settled. So this will also be settled ultimately by both of the parties. So you'll never see who is right or wrong. The settlement would be, I'll pay X fine. I will not admit wrongdoing, neither I'll admit this thing. And that's how all securities cases in the world are settled. So let's not worry about it'll be proven wrong, right or wrong. Matter will get settled. I think lesson learned here is that act fast if you think manipulation is done, if manipulation is done. But dividing line is, what is manipulation? I can do a strategy, buy and sell same day, and whatever I want to do. But there are other players who can counter me for it. So I'm not sure where the dividing line of justification is, but I think it'll get settled. Request is act fast so you protect what is the good thing in the market. But you can't. This will keep happening. Let's be honest. It'll keep happening.
This will keep happening is what you want at this point in time. Is there anything that we can do apart from, of course, realizing what's happening and acting fast or preventing it? I mean, is there any way we can prevent a Jane Street 2.0?
We don't want to prevent Jane Street. Why I say don't want to prevent? Because these are the companies which will give us the depth in our market. They trade big, they give you the volume, they give you the depth in the market, and more such entities come, we become a global established stock market at the end of the day. So idea is, we don't want to throw the baby with the bathwater. We want to just regulate them to say, behave yourself, and you do the right things. And that is where I think the problem came up, that it became 2 years is too late in a securities fraud or a manipulation environment to take action. But we don't, at the end of the day, yes, we want more of Jane Street to come because their depth in the market, which will give us the heft we have today. Look at the heft we have. We are doing 70% of IPOs in the world today. Now that heft comes not easily. So we don't want to give it away. So yes, there'll be bad with the good, but the good which has come to the Indian market is phenomenally more than this profit one company's made.
Absolutely. Well, it's been a fantastic 30 minutes of conversation with you.
Thank you very much.
Mr. Srivastava, it's been great catching up, and we could have gone on to understand more and more, but we'll have another day to speak about the other issues as well. But thank you so much for your time. Truly appreciate your presence on Business Today. All right, viewers, you have it heard from the top market master there on all the issues right now that are on top of your mind as an investor, especially on Jane Street, as he did mark out that we do need a robust F&O market. We cannot do without it. Secondly, he did say that for the market depth, it is important to have players like Jane Street, but we also need a robust system at play, at the regulators' end, so that such instances of manipulation, where there is a thin line between strategy and manipulation, if seen as a red flag, should be acted upon soon. But he also says there is no two ways about it. These cases will also get settled, as a lot of securities cases in the world have been settled. But what we must be watching out for is that another instance that causes a lot of harm to retail investors should be avoided at all costs. Thank you so much for being with us on this special conversation of Market Masters. We hope you really got in-depth understanding of what's happening in the markets, how are the top voices really looking at all the scenarios and all the factors that are moving the markets at this point in time to help you better strategize for your own trades. Thank you so much for watching, but do stay tuned on to Business Today. We will continue to get you all the insights from the world of business and finance right after this as well.
Submerged roads, damaged homes, and over 70 deaths. Incessant rains have wreaked havoc in Himachal Pradesh. From waterlogged